Welcome, everyone. This is an exclusive episode. This is part 3 of Valuation. When things go wrong. When things don't go the way that your discounted cash flow analysis and your original thesis, you thought it was going to go. That's what we're going to be discussing. Now, just in terms of recap, if you haven't already, go back and watch part 1, start with that, and then watch part 2. Part 1 is about traditional valuation in terms of looking at PE ratios, in terms of looking at price to sales, enterprise value to EBITDA, free cash flow yield, and arriving at the fair value of a company based off of mapping out its future cash flows and what's called a discounted cash flow analysis. That's part 1. In my opinion, I think that most investors today that do analysis, they basically do that first part. They look at companies, they might look at some historical charts, they map out the future cash flows, they plug it into a discounted cash flow analysis, they arrive at a number that's bigger than the number than what the company's trading at right now. They say the company's undervalued and they buy the stock. I think that's where most people end, is at part 1. That's why I came out with part 2. It's a continuation on the theme of valuation. Part 2 is all about risk. And this is where I think most investors fall short. When I look at where people spend their time focused on, they focus all of it on the future cash flows and mapping out the business and how it's going to do. They don't really pay a lot of attention to risk. And part 2 goes over extensively the different types of risks that different types of businesses face and how these risks are many times brushed off, pushed to the sidelines until they happen. And I showed the example of Intel as a company that faced many risks that are coming to fruition, that investors are now realizing that their analysis and discounted cash flows, it runs into trouble when it runs into risk. So risk is something that's difficult to quantify in a discount factor. I go over that in part 2. I think that's the most important episode. I think that's likely where you can get the most alpha. Part 3, again, is about when things just, this one's going to be about where things just don't go well, where they don't go according to plan. And in investing, I think there's 2 areas where we can outperform, where we can do better than most investors if we really put effort into it. One of them is having really intelligent, thoughtful, in-depth analysis on companies and rational analysis, where you look at companies, you look at all the risks they face, the operating risks, you try to find companies that have reduced amount of risks that are in very good industries with very strong moats, with very good secular growth trends that are trading at reasonable valuations. And you invest based off of that analysis, that you have structure to your investments. You have a analysis with pricing, and you don't let companies go too overpriced. I think the second part that we can outperform is strategically how we handle situations where things don't go according to plan. This is a behavior aspect. A lot of people struggle with behavior when it comes to investing. If things don't go according to plan, many people panic and they make emotionally driven, rash decisions where they sell at a much lower price than they bought. They sell companies that they once were very bullish on. They change their mind with companies a year later. And that's what I want to address in this episode. Now, let's just say hypothetically, you are learning about investing and you're looking at these companies that you're interested in investing in. You first start off with looking at Qualtrim and you look at the charts and things look really good on the charts. And the past 10 years look really good. You do some discounted cash flow analysis. You run the numbers on a spreadsheet. You try to buy companies that aren't in bad industries or companies that face a tremendous amount of risk. So you're investing somewhat conservatively, at least you think. And you decide that the company's undervalued and has very good future prospects. So you invest $10,000 into this company. Then let's say in 2 months, the earnings report comes around and the management doesn't seem so happy. They talk about all the risks they're facing, all the problems they're facing. A slowdown in the economy. Customers aren't signing up as quickly. Growth rates and estimates are being moved down. Analysts downgrade the stock, bumping it down $20 and $30 in price. And the stock falls 20% after hours, 15 or 20%, and then it starts to just trend downwards. that can be mentally tolling. When a company goes down 20, 30, or 40%, or even more, 50%, when that happens to a stock, sentiment follows, but even more intensely. If the stock price went down 30%, sentiment went down 50%. If a stock price went down 50%, sentiment went down 70%. Sentiment more intensely follows the stock price. When sentiment goes down on a stock that went down, it is intense. It's difficult to deal with mentally because we're social creatures. When, when everybody around you all of a sudden turns negative on a company that you were once happy to invest in and excited about the future prospects of it, when everybody around you all of a sudden is pointing out all the flaws of the company, how their cash flows are going down, or their margins are being contracted, or all these new competitors are coming, or anything's bad is happening, that makes it so it's very difficult to remain positive on the stock and to have resolve, to remain confident in your investment. And that's the mental game, the mental discipline, the mental fortitude that investors have to deal with is when things go wrong, when stock prices go down. How are you going to deal with that when that happens? Because if you invest in individual companies, individual stocks, that will happen. You'll have stocks that go down after purchase, and you'll have lots of chatter on the internet about how anyone that bought that stock was a dummy, and they should have seen this coming. And this is a big hole in the thesis and a big problem for it. Now, in my case, because I'm doing everything publicly and transparently, I get a lot of feedback, and I'll call it feedback, but a lot of it is, I get a lot of things that are glowing reviews of people that love everything that I'm doing, and I get a lot of people that are critics, that are very highly critical of everything I'm doing. And I've been able to have a front row seat to see different people react to different investments I make that go down after I make my initial investment, that go down in stock price. One of the examples I'll cite is a company in my portfolio called Vici. Let me just give you a little reminder of this one, a little story. I went to Vegas and I visited one of the properties that Vici owned, which was the Mirage. And I had a very enjoyable experience. I thought Vegas was just amazing. The food and the places you could visit and the shows and the hotel was amazing. It was just fun to get out. Now, this is a time when it was recovering from the pandemic. To make a long story short, a lot of people's attitudes are very bearish on Vegas and bearish on traveling because of the pandemic and everything. And what I saw was people excited to get back out. So I did research and I found out who owned this real estate. And it was a company called Vici. And then I was like, wow, that's interesting. They just own the real estate, but they don't own the casinos. And I found out that this company was buying all the real estate in all the casinos in Vegas, and that they're expanding outside of Vegas, and that they own these beautiful buildings. The Mandalay Bay, they owned half of that. They owned the Venetian. They owned the Mirage. They owned, at the time they didn't own MGM. That was a big outlier, but they ended up buying that too. They were buying all the properties there, and the company didn't have an investment grade balance sheet at the time, but they're planning on getting that. And once they get that, they get into a lot of different indices and they get into a lot of different institutional investments. So a lot of institutional investors cannot invest in companies that do not have that investment grade balance sheet. So Vici was working their way towards that. I stayed up doing analysis on the company late at night, reading all about it, reading the 10K, reading the 10Q, going over the quarterly reports. I was looking at transcripts of earnings calls of the company. I looked at the valuation of it. It was trading at a very low valuation relative to other REITs. I was looking at the fact that it was collecting 100% of rents. I was looking at the fact that it had inflation-adjusted, CPI-adjusted rents. I was looking at the fact that it had 40-year contracts. I was looking at the fact that it had iconic buildings that are irreplicable, that are impossible for the tenant to move out or replace, that it had a wide moat in terms of real estate, which is very unique. I was looking at the fact that the CEO is extremely transparent, going on to different YouTube videos and talking for an hour, answering investors' questions, being very open. Looking at the fact that they weren't selling any of their shares. All the executive team stayed committed in it. Everything I found about the company, I loved. I thought it was widely undervalued. And I started buying it. When I bought the company, I wanted to be transparent. So I made a video about me buying it in an effort to show everybody on YouTube what I'm doing with my money. So I introduced the new company. I make a video called I'm buying Vegas real estate, right? I'm buying Vici. The video gets 70,000 views. It's a lot of views for an investment video. One focused on one company, right? This isn't a personal finance video about credit cards. This is an investment video about one stock, one company. It gets 70,000 views. And this was before Vici was widely popular. Nobody was writing about the company on Seeking Alpha. It was a very undiscovered stock at the time. What happens after I make my initial big investment in Vici? The stock price just trends down, goes down 5%. And people are like, okay, you know, I can buy the dip or whatever. Goes down another 5%. It's down 10% from my initial buy-in point. That's kind of a bummer. I just made a video about how this company is a wonderful buy and undervalued and has a bright future, in my opinion, and then it's down 10%. I'm starting to look like a dummy, right? It goes down 20% after I buy it. And this is where the comments roll in. I make another video, like a month later. The stock's down. I'm in the red by a couple $1,000s. And people they're just writing mean comments. Not personally, but basically saying that I don't know what I'm doing. I'm just a dumb YouTuber. What do I know about investing? And that Vici is like, Joseph's pumping this stock. I'm glad that I'm avoiding it. And there's multiple of them. Lots of comments like this. Lots of people thumbs upping these comments. And I'm reading through them. And I just see in the comment section the sentiment. People thinking that I'm stupid for investing in real estate during COVID in Vegas, where there's a virus spreading. People saying that I'm stupid for investing in real estate that's not investment grade because it's highly risky. You know, all these different comments when my research was that it was a good purchase, that it was going to be something that I think had really good risk-adjusted returns, that it wasn't as risky as the market believed it was and was pricing it as. I had to deal with that negative sentiment showering down, and that really can change your mood. Now, luckily, I've been doing YouTube for a while, and whenever I buy anything, there's so many people that are negative on it and have different opinions on it, and sometimes highly critical, that I develop a little bit of a thicker skin. So I'm kind of used to this by now. I see the comments long enough to know that I trust my research, and I take data and logical arguments that people make, but I contrast that with my own research and my own thoughts on the subject. So by this time, I have a little bit of a shell, a little bit of a force field from these more critical comments, so I don't worry about the negative sentiment as much. I just keep buying Vici. All I had to do in this case, the first thing that I had to do to really make this investment a success was wait. Wait. That is number one. If you're wanting to know what to do when things go wrong with an investment, I think most of the time, the number one answer is to wait. Just give it some time to breathe. Give it some room. Vici I bought a year and a half ago, and after I bought the company, it went down in price. I did not time the bottom. Now I'm up $12,500. The company has an investment grade balance sheet. The company's expanded and purchased MGM. It's expanding outside of Vegas. They're doing all sorts of deals. They're probably going to be going international soon. The company's market cap has grown. The revenue has diversified. The leverage has come down. It's been included in the S&P 500. It has more institutional support. The executive team still hasn't sold a share of it. And it's shoveling $500 dividends into my account every 3 months. So in this case, all I had to do was wait a little bit, trust my research, and not get talked out of a solid company. And that's the first thing that I'd say in terms of just advice. If you've done research on a company and the stock price falls and they might have one gloomy quarter or something, don't get in your head too much about it. The only time that I would have really changed my opinion on Vici is if there's something that was truly thesis breaking, really something fundamentally wrong with the company. And I saw none of that. What I saw in the comments were trivial, temporary, short-termism thoughts of people that were basing my investment based off of a 1-month time period. When I gave the company a year and a half, it's done a little bit better, and it's all the fundamentals are moving in the right direction. So it's very difficult when you make an investment into a company that you think is undervalued to watch it go down more and more, to watch it have a bad quarter. Keep in mind, as investors, you do not want to be taking the immediate price trading after you purchase a stock as feedback to your decision, because stocks are volatile. They rarely ever trade right in line with their intrinsic value. If you focus on your research and you have structure and you have intrinsic values for your companies and you're watching those intrinsic values compound over time, give it time. Over time, the company's price will catch up to the intrinsic value. And if you've done good research on the company and the company's continually moving, continually compounding intrinsic value, the stock price will catch up to that. So part one, I think, is the most difficult part. And the story that I illustrate here is just to bring it to life, that I've had to be patient with a lot of my holdings because most of the time I do not catch them right at the bottom. I don't buy a company and then have it just go to the moon right afterwards. That's only happened, I think, one time. I think the only time that's really happened where I bought a company, and I don't think I've ever been in the red, ever, I think is Apple. I bought Apple like, 2018, early 2018. I don't remember ever being in the red with this stock. Like from day one, it was just in the green and it just went up more and it went up more. That's easy. If that happens, there's no problems, right? Mentally, that's not difficult. The tough point there is knowing when to take gains because you might take feedback of your stock going up as validation that you made a smart investment. So you have to, again, be disciplined in tracking the intrinsic value of the company. And if the company's stock price races way too far ahead of the intrinsic value, if the company's stock price has compounded much faster than the intrinsic value, that might be something to observe and maybe reallocate some capital to another one that's more in line with its intrinsic value. In the case of Apple, I invested in it. The stock price went up, but my estimations were that the company was still well below its intrinsic value. And I still believe that today. The stock price is in the green. I still believe that Apple has compounded its intrinsic value over time. The story of the Apple Store, the amount of service growth this company has, I think is going to be an ongoing thing that really does compound the company. But Apple's an easy one. I made an investment and it just went to the moon. That was an easy one. The tough part is when you make an investment and it goes down in price and they have a bad quarter after you make the investment. That's the true test of whether you have the discipline, the mentality, and the stomach, as Peter Lynch calls it, to be an investor in individual stocks. And if you can't stomach that happening, you're not going to be able to be an investor in individual stocks. You'll continually lose money until you capitulate and buy an ETF. So part one of this video, or at least I'd say the first item, is you got to learn patience. If you have no patience and you're investing in the longest form of investments, which is equities, that's not going to be a good match. You have to develop patience if you're investing in equities. They are volatile. They trade like crazy. Sentiment goes from lows to highs. Look at Meta. Sentiment was at lows, now it's at highs, right? You got to follow the intrinsic value and mentally detach from the sentiment, detach from the crowd, detach from the YouTube comments, detach from the Twitter comments, detach from what other people are saying that's not fundamentally analysis-driven, valuation-driven. That's very difficult to do. But I think that mentality is integral with valuation, because your valuations are meaningless if you don't have the mentality to stick with intrinsic values. And if your thoughts on the value of a company change at the whims of sentiment. So number one, be patient. Develop strict discipline and patience. Be cold, calculated. Don't get enthused and excited when stocks race up. If your company went up 50% in stock price, that shouldn't be making you just giddy with joy, unless you're potentially looking at locking in gains. But if you're just holding it, that means the company just got more expensive. You're getting a lot of good bids for it now, but you're not accepting it. Most investors cannot do this. This is why I think 99% of the market, they don't outperform. When stock prices go up, people get enthused. They feel better. They want to take the family out to dinner and celebrate. Their portfolio went up. We can't have that attitude. If you want to outperform the market, you have to be detached from the stock market. All of 2022, I was bullish. Every video I was saying things are okay. Stop panicking. Look at these companies. These companies are doing great. The economy's holding up better than people are saying. The Fed's interest rates, right? Like, invest in these great companies that are doing great things. Now in 2023, you might notice that my tone's changed. I'm trying to pour cold water on the party. Stocks are going up for no reason. People are excited. This is where I see people make very irrationally enthusiastic, exuberant decisions with their finances, and it won't work out in the end. So when we're investing and we're looking at valuations of companies, the valuation should be intrinsic value driven, looking at the things that are compounding the actual value of the company over time. It's free cash flow per share growth. It's earnings per share growth. It's revenue growth. It's increased market share, market structure position, reductions in debt, reductions in share count. Those drive intrinsic value over time. Stock price going up is you shouldn't be patting yourself on the back that you did something right. And in the short term, stock price going down is not an indication that you made an error in your analysis, no matter how many people try to tell you that. What is an indication that you made an error in your analysis is if you did not factor in the risks of an investment and a company has lots of operational risks that are now playing out. That's an actual error in analysis. So be patient. But the next thing is something else that I think is more strategic that I wanted to talk about, which is I like to think of it as almost like a defense mechanism for stock. Like if you're, I'm not a medical person. My wife's the nurse, but if you get a cut, you have bacteria that gets in the cut in the bloodstream, and then you have natural antibodies and you have natural things that come to the rescue to fight off the bacteria, right? If you're immune compromised, meaning that you don't have that natural, antibiotics is what you need if you're immune compromised, because you don't have the natural antibodies to fight off an infection. So, and I'm probably, again, I'm not medical, so don't quote me on this stuff. But the point is, some people have naturally better immune systems than others. If you're immune compromised because you're suffering with some illness or something, and then you get an infection, you need extra help. You need some outside third-party help, some medication. Otherwise, you might really get hurt, or an infection that could kill you. So if you look at stocks, some stocks have a better immune system than others. They're literally healthier. They have things to fight off infections and bacteria better than others. One of, I think, the tools to help with stock price drops, one of the tools that can make it so that you can just be confident in waiting out a stock price drop is like penicillin for the body. It's like an antibiotic. It's called buybacks. Buybacks are a magical tool that can make it so an investor that has a stock price drop can simply sit back and wait it out. And buybacks are dependent on the cash flows of a company. So in general, if you're wanting strategically to invest in companies that are more defensive, that have a healthier immune system, that can have some tools to deal with stock price drops, you can invest in companies that have very stable, reliable, predictable free cash flows, and cash flows that are very efficient and can be efficiently reinvested back into the company as buybacks. And I want to give you a couple examples of this. We have the example of S&P Global, company that I'm buying into, and the example of Cloudflare, a company I'm not buying into. And I want to highlight the differences in these two companies' immune systems if the stock price drops in price. Let me give you a hypothetical that each of these companies, both S&P Global and Cloudflare, they drop in half. They have a bad quarter where they give poor guidance, really poor guidance. They say things are slowing down, and investors sell out, and excuse me, the multiple drops 50%. So the multiple for both of the companies, the price, the market cap, boom, gets chopped 50% for each of them, Cloudflare and S&P Global. Well, one of these companies has tools at their disposal. One of them has penicillin to help fight this problem that it's now having. And the other one is left to itself. It doesn't have anything to help with this. It's got a compromised immune system. S&P Global has a great immune system. It's got the antibiotics to fight off. And Cloudflare is like a company that's like immune compromised. It doesn't have much to be able to do with this. Let me explain. When you look at the actual cash flows of the company, we can look at this right here. Actually, let me zoom out a little bit. We have the cash flow right here. So this is S&P Global's cash flow. This company generates billions of dollars in cash flow every year. So it's trading at like a $121 billion market cap, but it generates a good $3.5 billion of cash flow per year. And they're just doing this merger. So these cash flows are going to go up over time as well because the merger hasn't taken full effect yet. So the cash flows are going to go up to like $4 billion, maybe $4.5 billion per year. Then their cash flows are very efficient because we see if the cash flows get eaten up by dilution, they do not. Only $120 million goes to dilution to pay employees. So they generate a ton of cash flow. Look, $3.5 billion versus $120 million. It's like a little fraction, right? So this is very efficient. The cash flows they got are real cash flows. This is like, if the stock price drops, this is like a penicillin shot. What they can do, what this company can do is if the stock price got cut in half, if the market cap went to 60%, and oh no, Joseph looks dumb because he bought a company, it went down half in price. In this case, the management of the company could meet and have an executive meeting and say, man, our stock just got crushed, we're down 50%. But what this does is it makes it so that we can use our enormous amounts of predictable, reliable cash flow because we're a highly predictable business with a wide moat that's very reliable, recurring cash flows. We can use those cash flows to buy back our shares. And now that our share price went down 50%, we can buy back shares twice as fast. So this actually helps us out. This helps us meet our goals more. We can increase our earnings per share faster by doing buybacks at a faster pace. We can increase our free cash flow per share by buying shares at now half the price. So all the metrics that the company's trying to progress with, their free cash flow per share, their earnings per share, if the stock price goes down by half, the rate of growth in earnings per share and free cash flow per share go up dramatically because now the company can reduce the share count at a double the pace. Their buybacks are twice as effective. What happens when a company's stock price goes down in half and they start buying up 6% of the shares outstanding per year? I'll tell you what happens. The free cash flow per share grows at an accelerated pace. The earnings per share grow at an accelerated pace. Investors look at those buybacks and they go, wow, they're just hoovering up shares. And the more the stock price tanks, the more effective the buybacks are. It's like the company in and of itself, like the executive team can buy the dip. So in that case, the lower the share price, the better for the long-term investor. The company can reduce the shares outstanding, increasing your equity, making your share count a bigger proportion of the company. And over time, this causes the stock price to recover, typically sooner than later. This is a company that has tools to deal with a stock price fall. If S&P Global has their upcoming earnings report this week, if it's really bad, if they give a gloomy outlook, the stock price might fall. But again, the free cash flow yield right now is about 3% normalized. If it falls in half, that would make the free cash flow yield 6%. So they could buy back 6% of their shares outstanding per year. That's a 6% guaranteed return just by buybacks alone. Not to mention they're growing their free cash flow per share at like 15%. And if the stock price fell in half, it would be growing more like 20%. So they'd have 6% shares reduction per year plus 20% growth in free cash flow per share. That'd be a very attractive company. So it's unlikely it would fall that much because investors would see what they're doing, scooping up shares, increasing these metrics, and they'd bid the stock price back up. So the free cash flow gives this company a natural floor in stock price. Basically, it says, as long as this company has predictable, reliable free cash flow, the valuation feasibly can't come down that long or that much for that long. Over time, it's going to come back up because they have this tool. They have a very healthy immune system. Let's compare to the case of Cloudflare. Cloudflare is a company that has a $19 billion market cap. Okay, $19 billion, so almost a $20 billion market cap with a negative free cash flow yield. Because if we look at the free cash flows of the company, and this is quarterly, so we're getting the updated info here, it doesn't really generate positive free cash flows, okay? So investors are investing in this company based off of future cash flows. They're saying, yeah, we know it doesn't generate money right now, but we think 10 years from now, it'll generate a whole lot of money. So they're buying it right now. Okay, I'm not arguing with the investment thesis here. I'm just trying to illustrate the differences in how these companies can react to a stock price being cut 50%. So let's say that Cloudflare goes from $60 per share to $30, right? Cut in half from a $20 billion market cap to a $10 billion. That's not such a hypothetical. We've seen this type of thing many times. Lots of companies drop in half. Stocks are volatile. But the difference is in how these companies can react. The fact that Cloudflare generates no cash right now means they cannot take advantage of a stock price drop. They can't buy the dip. They have no money to. They generate no money that they can put into buybacks, meaning that for them, it's a terrible situation to be in if the stock price drops, not an advantageous position. Because not only are they not generating cash, but they're diluting to fund their business. So if the stock price drops in half, the cost of their equity of issuing shares just got twice as expensive. Another way of saying that is to pay their employees the same amount, they have to give away twice as much of the company. That's not a good situation to be in. You're paying your employees twice as many shares to pay them the same dollar amount. Not good. They have to grow their business and fund it with issuing more shares over time. So this is the exact opposite situation. If companies are doing buybacks, stock price drops are good for the long-term investor. If companies are funding themselves with dilution, like Cloudflare, a massive stock price drop is terrible because they're selling shares, and the thing they're selling just got half as expensive. Right? It got priced down at half, so they're making half as much money from their sales. So they'll have to dilute the shareholder at twice the speed to fund the same amount. This company has no ability to do buybacks. It's like an immune system that's immune compromised, that has no ability to fight off infections. They just got to hope for the best and hope that the stock price goes back up, hope that investors become bullish again. And if it doesn't, they're in trouble. Well, maybe they could fund buybacks through debt, right? Maybe they could just take out debt to buy this stock. They can do that temporarily, but you can't take out debt to buy stock forever. Otherwise, the leverage starts to go up on the company. The interest payments on the debt start to go up. And guess what we're in right now? A high interest rate environment. The cost of capital has exploded over the past year. So if they increase their debt to buy their shares, now the management team's thinking, wow, we're getting, the debt we're getting that's new, it's like 10% interest, no longer 4%. So the cost of debt has exploded. And if our stock price drops, the cost of our equity has exploded. This is the tough situations to be in when you're a company that doesn't generate cash flow. It's like being a patient that you're immune compromised and that you have no medication to help out. It's just very tough. You're having to rely on the story being good, on sentiment being good, and investors bidding up the price, on continually, having the future look really bright, because the current tools you have are not good in dealing with this. So if I invested in a company like Cloudflare and it dropped 50% of value, that'd be tough. I would be really bummed. I would not feel like it's a great thing for the company. I'd feel like I just have to hopefully go back to step one and wait around until it recovers. That would be my only option. With S&P Global, genuinely speaking, this company dropped 50% in value and the free cash flow went to 6%, and investors got spooked because of a slowdown or something. That would be advantageous in my position, unless the company's moat was like obliterated or something actually terrible happened with the fundamentals of the company. In that case, that would be a different story. But in the case of the stock price just ebbing and flowing over time and going down 10 or 20%, that's always great. This company's going to be doing buybacks. They're going to be reducing their shares outstanding. So to just revisit, I would say number one, if things don't go your way, if things go wrong after doing analysis, you're not unique. That happens to everyone. Not every stock Warren Buffett has purchased exploded in share price right after he purchased it. Many of them he had to hold for years. I've had many companies where I've had to exercise patience, and that's not an easy thing for me to do. I like to see results right away. But patience is necessary because Vici I bought into, it went down. I was patient, it recovered. Starbucks I bought into, it went down. I was patient, it recovered and went up. And these are companies I made money on. Texas Roadhouse, the same thing. I'm being patient right now with some holdings with Amazon. That's one that I just had to be patient. I'll have to wait a number of years to see if my thesis really plays out. And I'm not taking 1 year of trading I'm not taking that as an accurate indication of the quality of my research. I think another 3 or 4 years will show whether my research was accurate or not. So step one, be patient. Step two, if you want something that's actually tactically, something that can actually tactically help with the valuation and recovery of stock prices, having reliable, predictable free cash flows that are efficient cash flows, not diluted ones, that can be funneled into buybacks if the stock price goes down. That is something that really helps buoy stock prices back up. It makes it so that dips are temporary. It makes it so that if you're invested in the company and they're just buying back the stock, you can just wait. And eventually the stock price will recover. Eventually you'll get right back into the green. If they can do buybacks over and over again for prolonged periods of time, you're going to recover in stock price. That's what Apple does. That's what AutoZone does. That's what S&P Global does. It's what MasterCard does. These companies have efficient cash flows. If their stock price ever drops, they just direct that into buybacks, and it really helps with the recovery. So that's part 3. Let me know what you think of the series. I hope you've enjoyed it. If you've watched all the different 3 parts, let me know, and I might do these type of things in the future. I'll continue to do a little analysis on companies and show you how I arrive at fair valuation and the type of things I see in them. But I hope you enjoyed the 3-part series of valuation. Let me know, and I'll see you all on the Discord.